The final stage of grief is acceptance, and bears seem to be accepting of the fact that we are in a new bull market as the Nasdaq 100 makes new all-time highs. But now, as long-time perma-bears start to turn bullish, could this be the sign the market is topping? With the largest OPEX of the year behind us and stock markets finally entering their post-OPEX window of weakness, the possibility of a significant pullback becomes more apparent. And despite prevailing market euphoria, the data tells us a different story, especially with manufacturing PMIs missing the mark by a substantial margin. And these type of discrepancies is beginning to reveal the delayed effects of higher for longer. So as we end what has been the craziest week in the markets, join us today as we talk about stocks and the financial markets, and we answer the question, how much more do the bulls have left? Hello ladies and gentlemen, welcome to the daily recap show. My name is Chase. If you like this video guys, please subscribe. We got a lot in store for you today. And today felt like every other day in the market this year. We had the mega caps leading, software and semiconductors not far behind, and well, everything else red. Financials red, industrials, utilities, basic materials, just healthcare red. A couple of notable things though, we did see Costco up nearly 5% on a special dividend news and a huge dead cat bounce here in Pfizer. But looking at sectors, outperformers were semiconductors, tech, software, and the worst performing stocks were, real estate, regional banks, utilities, gold miners, healthcare. All in all, you could say it was some form of profit taking, some form of risk off into the weekend. And the Nasdaq just hit new all-time highs, and I think semiconductors really helped with this. It breached and closed above the 403.99 level. It closed pretty much at 405. This is the triple Qs. This was absolutely wild. And you know what's next? The SPX. And having a look at the majors, the Nasdaq was the best performing sector, up 0.5%, and the equal weight and IWM were the worst performing sectors, with the S&P 500 pretty much flat. Now, the S&P 500 recorded its longest consecutive win streak since 2007. After we've had 7 positive up weeks in the S&P 500, the returns we can expect up to 1 year later. And on average, we're looking at about a 12% return, 17 wins, 3 losses. I wouldn't say statistically significant, but stats nonetheless. And if you have a look at 4 weeks on 1 month later, we can expect about a 2% gain, and this trade has won 16 times 4 losses. So it seems that momentum feeds on momentum. Everybody is bullish on equities, and have a look at this data from BofA. In the past week, outflows from cash, treasuries, emerging market debt, and this was flowing into equities, US equities. So everybody is bulled up on equities, and this is because of the Fed pivot, but more importantly, what the Fed pivot means for earnings. The S&P 500 is expected to report 11.8% earnings growth in calendar year 2024. And if we look at EPS bottoms up, we should see growth from $220 per share to $245. Now, I think that's a bit rosy. I'm expecting $241, but if we hit 245, I'm not complaining. And what US companies are so great at doing is turning their revenue into free cash flow. And this is why US equities have performed so well in the last 30 years, because US companies generate so much free cash flow, and they use that cash flow to generate more cash flow, and then they give it back to shareholders in the form of buybacks. And we could see that corporate buybacks as a percentage of S&P 500 market cap is at the highest it's been since 2019. And the majority of these buybacks are coming from the Magnificent Seven. These companies produce so much free cash flow that they just give it back to the investors in the form of buybacks. And this, along with earnings expectations growth in 2024, is why investors are so bulled up. According to the AA sentiment survey, 51.3% of people are bulls, a mere 19.3% are bears. And have a look at the 1 year bullish high, have a look at the 1 year bearish low. It's all at the 50% handle, and we could see a pullback in the market. So I told you guys yesterday, if you have been long, just trim a bit of exposure, take some profits. And since market euphoria has set in, the Fed is rushing to take back some of its statements. The Fed's John Williams said the central bank isn't really talking about rate cuts right now. But we still have to ask the question, why the sudden pivot? And I believe, in my personal opinion, the Fed is seeing signs that they don't want to see, because they said they're willing to cut rates even if the US economy doesn't dip into a recession. Now, why would they say that? The Fed is obviously seeing some worrying indicators in the data and they need to pivot, and they're probably seeing signs of deflation. Look at the EMS data we received today. It missed by a large margin. Along with this, we are seeing a ton of other signs of deflation. Have a look at the spot price of eggs, down 42.7% from last year. And have a look at energy prices. Have a look at health insurance, airline fees, major appliances. Huge amounts of deflation. The Fed is really worried about this because deflation leads to lower prices, lower consumer spending, and it just contracts the economy. The Fed doesn't want deflation. It just wants a little bit of inflation every single year. Now, a decrease in consumer prices year over year isn't necessarily a bad thing, because when the Fed pivots, it decreases rates. That bodes well for equities. And normally what we do see 1 year on in the S&P 500 after a 5% decline in the CPI is about 14.94%. Let's call it a flat 15%, with the only year 1947 being negative 1 year later. But it was positive 6 months on. So that was a very choppy year. Let's talk about the greenback. The DXY was down 1.2% this month. It's really good to see the dollar falling because it's been insanely strong, and what we're seeing here is the 1 month option skew for the dollar, and essentially looking 30 days out, the bets look more bearish than positive, and it's some of the lowest skew we've seen since June 2020. And this is really good because international revenues get converted back into US dollars, and that boosts overall profit, and that's really good for the bottom line and equity prices. If the Fed cuts rates and we get a recession, what we normally see is peak drawdowns of about 15 to 20%, 10 plus months on. But if we miss a recession, we normally see multiple expansion and an uptick in equity prices upward of 10% on the same time frame. We've been talking over the last few days how to position ourselves for a recession. We spoke about consumer staples last week, we spoke about communication services, and today we're going to speak about energy, the best performing sector in a recession. And the reason is everybody needs to look after their health, especially as the population ages. Now, this might be a good bet regardless, because healthcare is expecting earnings growth of 19.1% in the calendar year 2024. It's actually the highest growing sector out of everything, even outperforming technology data according to FactSet. And if we look at valuation metrics, it's trading at a 17 PE. Some would say expensive, I don't think so. Also on an EV to sales of 1.8, and fairly average in all the other metrics. And according to analysts, healthcare is 60% of analysts call it a buy, 37% say hold, and the lowest sell rating out of every sector in the S&P 500. Now, what does exposure look like? You can buy the XLV, get exposure to all of these companies, or just have a look at Eli Lilly or United Healthcare. These are some of the highest quality healthcare names, not just in the US, in the world. Let's say we get a soft landing, no landing. Where do we want to be positioned? Now, healthcare is a good option. Say we get the soft landing, equity prices bid up. Where do we want to be positioned? And I really think small caps is a place where you could really produce alpha over the S&P 500. Now, have a look at this disconnect. Russell 2000 prices against Russell 2000 dividends versus the S&P 500. S&P 500 prices and dividends have trailed each other, whereas Russell 2000 haven't. And that means either Russell 2000 prices are lower and the yield is much higher on Russell 2000 dividends, but since this is price performance weighted, Russell 2000 companies are relatively producing more earnings relative to their price. And this is why we should see an uptick, a revert to the mean in Russell 2000 prices, in small cap prices in 2024 if we don't get a recession. Let's dive into the metrics for Russell 2000, and almost on every metric except one, the Russell is expensive. Now you would say, oh, what about price to earnings growth? It looks expensive. It's 1% overvalued. That's probably fair value. Looking at forward PE, this is where it gets crazy. 13.4 average, minimum 8.4. The highest PE in the Russell 2000 is 19.8. That's the S&P 500 average. So you're getting good value here. 13.4 is really, really cheap. Enterprise value to free cash flow is really cheap. This is a very, very cheap metric. And I also think that the price to book is quite cheap, relatively speaking. And all in all, the only expensive metric here is price to sales, and that's 21% over the long-term average. But I wouldn't recommend you actually go out and buy the Russell 2000. Look at maybe the S&P 400, or look at small cap quality ETFs or small cap growth IWO. I think you're going to get much better outperformance in those relative to the Russell 2000. Now, we just had OPEX and we are entering the Varna and Charm window of weakness. There's not a lot of gamma at the moment. It needs to build up into the month of January, into the end of December. This could be when we get a pullback. These supportive flows are no longer in the market. They are there, but they're not as big as they are in the middle 2 weeks of the month. We could see a pullback sometime in the form of a correction, both in price or time, either or. But this is what I think is going to happen. If the gamma resistance repositions itself at 4800, we're going to slowly move up to the 4800 level by the 12th of the 27th. But if the gamma resistance stays at 4700, we can expect digestion between this level up until the 27th of December. And after the 27th, after we get this choppiness, we should get a fake out and then higher price action above the 4800, 4850 level at most. Here's the JEX map, 4700 call gamma strike with a ton of gamma building at 4750. And I do expect all dips to be bet by bull demand at this 4700. We might go a couple points below, but 4700 is going to be very, very hard for people to break through. But we have to see where this repositions itself on Monday. Now let's go on the S&P 500 chart. This is the year to date of the S&P 500, and here's what I'm expecting. If the gamma strike repositions itself at 4800, what I'm expecting is sort of us to move higher into this 4800 level and go hit new all-time highs. If the gamma resistance stays at 4700, we're going to get choppiness, then a fake out, and then a run up all the way to 4800 into January. Those are my two positions. We go up or choppiness up. What small caps want to do here is get above this level, use it as resistance, and then move higher. That is the ideal play. Otherwise, we could see another mean reversion trade for the IWM. And looking at the dark pool activity, there's a lot of volume here that you need to contend with. But if they do get above, I think this is going to be a very supportive zone for the IWM. So everything hinges on this 200 level. I do favor price action to the 212 level in the future. Looking at semiconductors, and they've broken out from this cup and handle, I think we see a price target of 235. This is going to absolutely soar. We should see some form of a pullback and then higher price action towards into 2024. Looking at regional banks, we're back at the scene of the crime, the 56 level right here. And regional banks really want to get into this 56 level and form a base right there. That's really what regional banks want to do right now, because these guys are weak. Any form of bad news and regional banks dump. Okay, so regional banks form a base right here, build out this volume pocket. Okay, build out some volume here so you can have support and look to higher price action in 2024. Real estate, and it looks like real estate have just bottomed, and we've broken out from this trend, higher highs, higher lows, and it looks like very much the same like regional banks. We sort of just want to base around here, build some support, and then look to higher price action into 2024 as rates fall. TLT, interesting stuff. Look at the huge volume we're seeing, and what you really want to see with TLT is a break above the 100 handle and then move into higher price action as yields fall. But a lot is dependent on macro and economic policy, more so than what's actually happening on the chart with this one. And just a little bit of stats. S&P 500 performance after November and December produces an 11% plus gain. Normally we can expect average returns in January, the next month, of 4%, the next quarter 6%, and 21% returns the next year. And if we remove the outlier of 1914 where equities were up 82%, can expect gains of about 15%. And that has a hit ratio of 80% of the time. Very bullish stats. If December and November do close above this handle, anything can happen. We do have quite a bit of data next week. We got PCE, durable goods, initial jobless claims, consumer confidence is a big deal. That's about it, nothing more. But if you've made it up until here, thank you so much, guys. Subscribe to me, hit the like button, leave a comment, hit the notification bell. Cheers.